The stock market is currently closed right now, and the official closing price for SoFi Technologies, trading under ticker symbol SOFI, stands at $17.42 per share as of the market close on June 17, 2026 at 4 p.m. Eastern Time. While many retail traders looking at basic investing sites might assume this minor downward intraday slip of 1.64% is just standard noise, something much larger is happening behind the scenes that completely rewrites the script for this financial platform. Right as the closing bell rang, institutional interest spiked on the news that this company has quieted the skeptics by securing a direct role as a primary retail broker for high-profile private aerospace initial public offerings, alongside launching its own national bank-issued stablecoin called SoFi USD. Most regular participants think of this ticker as a volatile consumer lending asset that moves wildly based on federal interest rate decisions, but the reality is that the underlying tech infrastructure is quietly capturing massive operational leverage. This unexpected pivot into tokenized banking and exclusive equity distribution creates an immediate curiosity loop for anyone involved in self-investing or modern wealth building, making the current pullback look like a complex setup rather than a simple trend reversal. When you discuss this ticker with fellow market participants over a casual conversation, the common expectation is clear. Most retail investors believe that this digital financial firm is forever trapped in a brutal cycle of high customer acquisition costs, constantly fighting for survival against massive traditional institutions and modern retail platforms. The general consensus says that unless the Federal Reserve slashes interest rates rapidly, consumer credit expansion will stall, defaults will rise, and the stock will continue its multi-month grinding descent below its 52-week highs. That expectation paints a picture of a fragile fintech platform. However, the reality on the ground tells a completely opposite story. While everyday accounts on the Robinhood app or those seeking generic investment help across forums worry about the immediate loan origination margins, this platform is rapidly morphing into a core technology layer that other financial entities must pay to use. By looking past the surface consumer brand and analyzing the actual enterprise software revenue generated through Galileo and Technisys, we see a highly profitable infrastructure business disguised as a consumer digital bank. This means the marketplace is pricing the equity based on lagging consumer loan metrics while completely ignoring the high-margin recurring software fees that shield the company from macroeconomic downturns. If we zoom in to the specific price action over the past few weeks, the sheer scale of trading activity is impossible to ignore. On days when popular tech options like Nvidia stock or Apple stock dominate the financial headlines with massive capital inflows, this particular financial ticker has quietly experienced enormous blocks of institutional accumulation. During the session on June 17th, the trading volume surged past 81 million shares, showing that heavy fund rotation is actively underway. We have witnessed a series of aggressive daily swings where the equity dropped to low points near $14.36 before snapping back rapidly toward the $18 level. This massive volatility is not random retail churn, it is the footprint of large institutional block trades. Public filings reveal that sovereign wealth funds and major asset managers have been loading up on shares through their individual brokerage accounts, exploiting the retail panic that followed short seller allegations and temporary regulatory inquiries earlier this year. Every time the price dips into the mid-teens, massive institutional buy orders trigger automatically, setting a hard floor under the equity that short sellers are struggling to break. When you look at the entire landscape of modern trading systems, from traditional platforms like Fidelity Investments to highly active alternatives like interactive brokers trading, the battle for user deposits has never been more intense. Many traditional retail investors prefer utilizing Fidelity mutual funds, standard Fidelity ETFs, or setting up automated accounts via Schwab Intelligent Portfolios to secure stable long-term returns. At the same time, active options traders flock to the Interactive Brokers platform due to low Interactive Brokers fees or manage their capital via the Interactive Brokers account structure. In this hyper-competitive arena, the recent quarterly financial results from this digital banking giant completely shattered the bear narrative. The company reported a staggering 42.6% year-over-year revenue growth, pulling in over $1.1 billion in a single quarter, while recording a 134% surge in GAAP net income. This level of fundamental growth is almost unheard of for standard banking institutions. While users on the Robinhood stock trading platform were busy chasing speculative meme assets, sophisticated capital was moving directly into this digital bank, attracted by a record $12.2 billion in new loan originations. The broader financial sector is currently dealing with significant macro pressures as the market prepares for the upcoming interest rate decisions under the newly appointed Federal Reserve leadership. This macroeconomic uncertainty typically causes defensive positioning, with traditional wealth managers reallocating assets toward the Fidelity trading platform or advising clients to use a basic Fidelity brokerage setup for safety. Yet, the momentum within the advanced digital finance segment is starting to separate from traditional regional banks. A major catalyst driving this internal strength is the aggressive open market buying behavior of the company's chief executive officer, Anthony Noto. In the first half of this year alone, the executive has executed 5 separate open market share purchases, deploying over $2 million of personal capital to buy his own company's equity during periods of market weakness. This is not a symbolic insider purchase, it is a massive vote of confidence that signals a deep mismatch between the public stock price and internal corporate performance. When the person running e-enterprise is aggressively buying millions of dollars of shares on the open market, it forces the entire institutional community to rethink their short positions. To truly grasp why this asset is diverging from its peers, we need to understand what the company actually does and how its modern ecosystem functions. Long before it became a fully licensed national bank, the enterprise built its reputation in the high-yield student loan refinancing market.
Today, it has evolved into a comprehensive financial services platform that offers everything from high-interest savings accounts to self-investing options via its proprietary smartphone application. The business model relies on a powerful financial services productivity loop. When a consumer opens an account to manage their personal capital, the platform uses that relationship to offer low-cost cross-selling of insurance, mortgages, personal lines of credit, and automated wealth advisory through the SoFi robo-advisor system. This eliminates the massive customer acquisition costs that plague other pure-play digital lenders. Furthermore, by owning the full vertical stack of banking technology through their software subsidiaries, they can process transactions at a fraction of the cost incurred by traditional legacy institutions, allowing them to pass the savings back to consumers in the form of superior interest rates. If we compare this offering to the rest of the industry, the distinct differences become incredibly obvious. For instance, while a conservative investor might look for investment help through Fidelity Wealth Management or set up tax-advantaged accounts via Fidelity IRAs using the Fidelity mobile app, younger wealth builders are seeking an integrated all-in-one digital experience. This platform provides exactly that, combining active trading, crypto access, and cash management under one roof, much like the Robinhood app, but backed by the regulatory safety and massive deposit base of a true chartered bank. Users can easily purchase SoFi ETFs, engage in SoFi active investing, or buy fractional shares without jumping between different specialized platforms. Unlike the standard Robinhood cash management features or the automated allocation rules of an intelligent portfolio at a legacy firm, this company utilizes its growing deposit base to fund its own loans directly. This unique capability means they do not have to rely on expensive warehouse lines of credit from third-party Wall Street banks, drastically expanding their net interest margins even when the macroeconomic environment gets tough. As we look at this massive divergence between what the general public expects and what the financial reality shows, it is time to gauge where real retail conviction stands right now. Comment below how many shares of SoFi you currently hold in your individual brokerage or retirement accounts, and let me know if you are actively buying this pullback or if you prefer keeping your capital parked in traditional tech names like Tesla stock. Understanding the collective sentiment of the community helps us see exactly when retail capitulation ends and institutional accumulation takes full control. The commentary section gives us a raw look at whether everyday wealth builders are choosing to invest online via advanced digital platforms, or if they are retreating back to standard legacy brokerages during this period of heightened market volatility. Looking ahead into the final months of the year, several massive catalysts and structural risks are poised to test this asset's resilience. The most significant structural opportunity lies in the rapid adoption of their new stablecoin asset, which allows the bank to facilitate near-instant cross-border settlements while completely bypassing traditional expensive clearing networks. This moves the company into direct competition with highly specialized institutions like the Interactive Brokers platform, but with a massive retail audience already built in. The risk, of course, is that regulatory scrutiny on digital banking assets is intensifying globally. If federal overseers implement restrictive guidelines on bank-issued stablecoins, it could temporarily slow down this monetization track. However, if the regulatory framework clarifies favorably, the company's first-mover advantage as a chartered national bank will create an incredibly deep competitive moat that alternative investing sites simply cannot replicate. In conclusion, the overarching narrative surrounding this digital banking powerhouse is defined by a massive tension between market expectations and fundamental financial realities. The broad market continues to price the stock as a simple interest rate-sensitive consumer lender that belongs in the same category as basic Robinhood investments or Fintech experiments. But the reality revealed through their explosive GAAP net income growth, dominant technology platform revenue, and aggressive insider buying proves that this is a rapidly scaling financial infrastructure giant. While traditional investors are staying safe inside old-school systems like the Fidelity trading platform or relying on automated settings in a Schwab Intelligent Portfolios account, this platform is systematically absorbing the next generation of deposit capital. The temporary daily swings and minor pullbacks we're seeing are merely short-term noise obscuring a long-term structural transformation. By maintaining a clear, analytical view of these core operational metrics, we can easily see past the surface-level panic and recognize the immense structural power building within this unique digital banking enterprise. To fully maximize our perspective on the macro-financial environment, we must also examine how this asset interacts with broader digital capital deployment shifts across different age segments. Investors who used to depend on standard online investing frameworks or generic online investment advice are suddenly finding themselves forced to migrate toward highly agile systems. This is particularly noticeable when you look at how younger demographics interact with their preferred investing applications. For a long time, the dominant narrative suggested that standard retail networks would lose their momentum as soon as regulatory penalties or liquidity crackdowns hit the digital asset space. Yet, when we track how consumers utilize alternative systems like the Robinhood crypto wallet, or how they seek out specialized Interactive Brokers stock trading tools, we see that the demand for modern multi-asset management has never actually faded. It is simply consolidated into platforms that can offer institutional safety alongside retail flexibility. This instant inflow shift is exactly where the core strength of the company lies, as it bridges the gap between traditional consumer savings accounts and advanced high-speed trading architectures. Moreover, the enterprise technology layer known as Galileo represents a massive part of the long-term financial equation that most traditional financial analysts completely fail to model correctly. When retail commentators discuss SoFi investing or look up basic updates on generic SoFi stocks, they usually look only at user account growth or the performance of specialized index tracking products like specific SoFi ETFs. What they miss entirely is that this company acts as the literal back engine for hundreds of other fintech apps and digital banks across the globe. Every single time a customer on a third-party digital card swipes their account or wins a transaction, this company collects a small infrastructure processing fee. This hidden business line means that even if domestic loan origination slows down due to structural changes in the mortgage market, the recurring business-to-business software fees remain a massive structural support. It is this unique software layer that differentiates the firm from standard consumer applications, turning it into a diversified financial power that benefits directly from the systemic trend toward total banking digitization. When When we map out the competitive landscape against other retail brokerages, the absolute scale of user engagement becomes the primary metric to watch. If you take a look at the massive user base using the Robinhood Investments platform, or those executing fractional orders via Robinhood fractional shares, the primary focus is almost always on speculative trading volume. Traditional firms that offer comprehensive wealth advisory, such as Fidelity Wealth Management or various automated portfolios managed through advanced financial sites, tend to capture older, higher net worth individuals who rarely execute active credit transactions. This digital banking enterprise is uniquely positioned to capture both sides of this equation by turning low-balance checking accounts into long-term wealth management clients. As these younger users build their corporate careers and require larger financial products like home loans or advanced business credit lines, the platform can service their needs instantly without spending a single dollar on new marketing campaigns. This self-sustaining loop creates an incredibly sticky ecosystem that structural short sellers have consistently underestimated, leading to the dramatic short squeeze cycles we have witnessed during recent earnings periods. Ultimately, navigating this particular market segment requires looking past the daily emotional swings of the retail crowd and focusing strictly on the hard regulatory data. The path forward will likely involve a continuing series of volatile weekly swings as macroeconomic shifts and institutional rebalancing play out across the broader indices. Investors who panic and sell their holdings based on surface-level headlines often find themselves buying back into the equity at significantly higher prices when the fundamental data confirms the underlying growth. By monitoring institutional accumulation patterns, watching the expanding margins of the enterprise software segments, and tracking the steady growth of low-cost consumer deposits, we gain a clear, unvarnished